Hello, I'm James Mills and you're watching CATEX-TV, broadcasting live from Princeton, New Jersey. The time is currently 11:30 a.m. in New York, 4:30 p.m. in London, and 12:30 p.m. in Hamilton, Bermuda. Firstly, on this day in 2003, the United States, along with coalition forces, primarily from the United Kingdom, initiates war on Iraq. Just after explosions began to rock Baghdad, Iraq's capital, US President George W. Bush announced in a television address, "At this hour, American and coalition forces are in the early stages of military operations to disarm Iraq, to free its people, and to defend the world from grave danger." President George W. Bush and his advisors built much of their case for the war on the idea that Iraq, under dictator Saddam Hussein, possessed or was in the process of building weapons of mass destruction. And now we'll go to our main news. The boss of US insurer AIG has called the bonuses paid to executives distasteful and said he asked some recipients to return at least half. But Edward Liddy said the Federal Reserve knew in November of the $165 million bonus payments to executives that have caused a furore in the US. Mistakes were made at AIG on a scale that few could have imagined possible, he told the congressional hearing. Lawmakers are also taking steps to recover the bonuses. Mr. Liddy also admitted that AIG was too complex, too unwieldy, and too opaque. He said that he had asked AIG executives receiving a bonus of more than $100,000 to pay at least half of it back, and he later reported that some of the firm's executives were following his wishes. The insurer has taken about $170 billion of aid to the US government, which is why the bonus payments have caused such outrage in the US. US lawmakers are considering several different responses to the controversy. The House of Representatives will on Thursday vote on legislation aimed at recovering the AIG bonuses. The bill would apply a 90% tax rate on bonus income of $250,000 that was paid to companies that received at least $5 billion in bailout money. In banking news, Citigroup Inc. plans to sell $3 billion in bonds backed by credit card payments, eligible for the Federal Reserve's program to jumpstart consumer lending. The AAA securities will mature in 2.97 years and may price to yield 175 bonus points more than the one-month London interbank offered rate, according to a person familiar with the transaction who declined to be identified because terms aren't public. Citigroup's debt sale is the first offering backed by credit card payments, announced for the Fed's Term Asset-Backed Securities Loan Facility, or TALF. Earlier this week, the finance arms of Ford Motor Company and Nissan Motor Company announced plans to sell bonds backed by auto loans. Huntington Auto is also planning a sale. The Obama administration is counting on TLAF to help end the credit crunch and recession by thawing the market for asset-backed securities so lenders can make new loans to consumers. Investors are shying away from credit-backed security debt as consumers fall behind on payments and unemployment rises. Today is the deadline for investors to apply for Fed loans for March. The US dollar has fallen against all major currencies after the US Federal Reserve announced a plan to buy $1.2 trillion of debt to boost its economy. The dollar fell by 2.9% against the euro and by 2.5% against the pound. The US currency also declined against the yen, the Norwegian krone, the Australian dollar, and the Brazilian real. The Fed's decision to buy debt means it is effectively creating new money, leading to concern from investors that the oversupply of dollars. The dollar traded at 1.433 against the pound, its lowest since late February. The US currency also had its biggest drop against the euro in over 2 months to 1.3506 versus the 16-nation currency. Against the yen, the dollar bought 95.55. The decline in the dollar ended its rally so far this year, which has seen the US dollar rise by more than 2% against most major currencies. In Iceland, the central bank of the crisis-hit country has cut its interest rate to 17%. The Fed rate is the first since Iceland agreed a $10 billion financial aid package with the International Monetary Fund. Rates were cut by 1 percentage point from 18%, where they had remained since October on the recommendation of the IMF. Iceland's financial system collapsed in October under the weight of debt, leading to a currency crisis, rising unemployment and public protests. Iceland's economy is forecast to shrink by almost 10% this year. The country's currency, the krona, has stabilized since the October meltdown. The central bank raised rates by 6 percentage points in October to the record high of 18%. Meanwhile, in the United Kingdom, the UK's deficit widened to £8.99 billion sterling in February, a record level for the month, official data has shown. This was 8 times the figure seen a year earlier, as tax receipts fell 10%, causing the government to borrow more. As unemployment has risen and firms have seen profits fall, this has hit the money government collects in taxes. The cumulative deficit for the fiscal year is £75.2 billion sterling, increasing the chance that the government will borrow for the year, and what they will borrow is going to exceed its own £77 billion forecast. The total government debt is equivalent to 49% of the gross domestic product. Philip Shaw, an economist at Investec, said the deficit was slightly wider than expectations.